All righty. Welcome back to the Credit Unions Forum podcast. I'm Greg Cook, and today we're diving into one of the most important conversations happening in our movement right now. Can small credit unions survive and thrive in today's environment? Joining me is Doug Wadsworth, President and CEO of Tri-CU Credit Union, Washington State, founder of the Endangered Small Credit Union Defense Initiative, and author of Keep It Simple CEO, a DIY profitability guidebook for small credit unions. Doug's become a strong voice for small institutions, advocating for practical leadership, operational simplicity, and regulatory relief. Staying deeply connected to the communities credit unions were created to serve. Doug, welcome to the show.
Thank you, Greg. Good to be here.
Alrighty. Well, we're going to kind of bounce around. We were talking beforehand on a number of different topics. I've got a few things I want to make sure we touch on. First off, what inspired you to write Keep It Simple CEO?
Thank you. Probably I realized about a year ago, I realized that at some point I'd be retiring. And I got to thinking, man, I've been here for, almost 20 years. When I started as the CEO, it was just about to go underwater. And it was about 15 million in assets. And it was kind of everything was on fire. And I had all kinds of interesting experiences. And over the years, I've learned all kinds of lessons and seen all kinds of things happen. And overall, we've been a very profitable small credit union. And we finally reached the point where we're so profitable, we're trying to give money away back to our members, which is what we're really focused on. Me and the board of directors and the employees. That's what credit unions are about. You're supposed to give.
Looks like I might have to join you guys.
So anyway, I was like, man, I'm going to start writing all this down for whoever takes over me when I'm gone. And then I thought, apparently it's pretty easy to publish a book now. And oh man, it was so easy. I just basically typed it all up, reread it several times, retyped it. And finally I was like, okay, I'll never end. I'm just going to publish it. And you can publish it on Amazon for basically nothing. And they just take a little cut of the proceeds. And so I did it. So put it all out there. And I'm a little unorthodox. I'm really all about DIY and doing things yourself and saving money and focusing on lending. And I do it in weird ways. And I say what I'm thinking. So sometimes it's a little spicy. So I just thought, what the heck? I'll throw it out there. And I thought maybe I'll sell 5 books. Who knows? And it's actually been pretty successful because it turns out there's no other books for small credit unions just about running a small credit union. Buy a small credit union CEO for a small credit union CEO. So it's been fun.
Wow. So
yep.
I was reading your book actually, and I think after the first or second chapter, it talks about a further back chapter, lending. I think chapter 6 takes you back into a ton of lending, and I know this conversation is going to bounce all over the place, but that's very important in today's day and age. I mean, that's where, that's the core part of our business, lending.
That's our bread and butter. Yeah.
Why don't we spend just a few minutes and kind of go through some of the, I guess, quick wins that other credit union CEOs that are, in that smaller realm that, could potentially think about, and obviously give them a reason to buy the book.
Yes, you bet. And I should mention here, one of the best things you can do is find a really good person. And man, I really lucked out. I was blessed that way, but had a really good vice. I hired so first of all, I took over and lending was, of course, in the toilet. We were like, I don't know, 60% loan to value or something, or 60% loan to share ratio. And I was like, man, I got to get loans up. And I worked. And this was right in 2008. And rates went all the way down really, really low. And I thought, you know what, I'm going to do like a 10-year mortgage refinance for people with great credit. And they have lots of equity in their home. There's no risk. I'm just going to be like, no appraisal needed. We'll just use a tax assessment, no origination fee. We'll do these rock bottom rates for a 10-year term for old folks who want to get out of their mortgages. And it was great. I needed tons of them. But that still was like barely a drop in the bucket. And my loan to share ratio was still low. And I knew that's how I needed to make money. So then I went to this conference in, I think it was in Las Vegas. It was the CU Directors Conferences, which I haven't been to since then. But this guy spoke, Brett Christensen with CU Lending Advice. And he's like, if you want to get loans, the only way you're going to get loans is if you hire somebody and pay them a commission. And that felt so wrong because that just doesn't sound traditional. I had worked at a credit union for a few years before that. And it just didn't feel like the credit union way to pay somebody a commission. But he's like, it's the only way you're going to grow loans. You got to pay a commission for selling loans. And then they have the incentive and the motivation. If you get a person who's a true salesman, and as long as they understand the credit union mission and what credit unions are about, and they're honest. Anyway, I found a guy, and he was great. And
Okay.
and he started making connections with car dealerships. And then after that, he started making connections for HVAC loans with the contractors. So most of our loans come from business partners, business relationships that he's established. And we came up with products that were really competitive and fast and easy. And we had tricky ways to get them to start using us until they liked us. And we've been over 90% loaned out ever since. That was like 15 years ago.
Wow.
16 years ago.
Now in your book, so after I read the chapter and it said lending is back in chapter 6. So I couldn't even wait. I wasn't going to wait 4 more chapters. I skipped right back to the lending chapter because I'm like, I've never read a book where it says go back to this chapter for this part. But I literally I had to skip over those because I was that interested in getting into the nuts and bolts of it. So one of the things you talk about is the HVAC lending.
Yeah.
And maybe I'll kind of have you elaborate just for a couple minutes on that, because you started talking about how at first you were doing liens, but then you stopped and you were doing UCC filings. So maybe you could elaborate on that one a little bit.
Yeah. So the whole HVAC thing, basically of course, when you're a small credit union, you can't compete with the big guys for the loans they're trying to get. There's just no way. So we were looking for niche lending opportunities that was kind of fly underneath the radar of what the big credit unions were out shooting for, because we have a whole bunch of big credit unions in our community. We're the only small one here left now. And so we came up with, this is like 15 years ago, I guess about 14 years ago or something. We came up with loans for heat pumps here in town. And so we went out to some of the people that were selling the contractors that install the heat pumps in your house. And we're like, what are you guys doing for financing? Like, oh, we sent it to some company, out of state company. It's just some finance company. And we're like, well, how about we do that financing for you? And like, okay. So we kind of figured out a way to figure out what the rates were and how long it took them. So we're trying to be real competitive. But we really wanted to get them using us. So Trevor, who's actually taking my place when I retire a year from now, he's my VP of lending. He's going to be the new CEO after I retire next year. He's like, well, let's do a real sweet deal that helps them sell more units and gets them in the habit of using us. So he came up with this idea to offer basically a no payment, no interest for like 6 months. Which makes it real easy for the heat pump guys to sell more heat pumps. Because when they go out and install them, people are like, how much does it cost? Is our loan? And so they can say, well, yeah, but it's a super good deal. Anyway, so we had these really sweet deals and introductory perks. And the contractors started using us. And then after 6 months, when we finally sunsetted that deal, they loved us. And then we figured out how to be faster and smoother and easier. And we kept it local. So since then, we've just grown it to additional other HVAC contractors in town, but it's mostly heat pumps. And the volume, the loans are only like $8,000. Well, they used to be $8,000. Now they're more like $10,000 or $12,000 for a heat pump replacement. So it's not a huge volume thing, but man, I think we do almost every heat pump loan in the Tri-Cities in our whole community. We finance them.
Wow,
and so
that's such a success story. Now,
been fantastic. Oh, did you want to talk about the UCC versus the?
Yeah.
Okay, yeah. So initially we were doing it with just a wild deed of trust, so that we didn't have to do title insurance, because it takes a long time. You got to order title insurance, you got to wait for it, and it's more fees. So initially, because our whole goal is we got to make it fast and easy, and cheap, easy for the person applying, easy for us. So initially we were doing wild deed of trust, but it was a real pain. I mean, it worked and we did it, but and we didn't get an appraisal. We stretched the term out. I think there's details in the book, or you can go to our website if you want to read about it, how to do them. But eventually it was just a pain in the neck. Every time an examiner came, oh man, they're always like, well, did you do it? And then initially the regulations changed. When we started, it was the good faith estimate model. And then they had the truth in lending, which made it more complicated. And you're supposed to give them a truth in lending disclosure, like the moment they apply, and then you're supposed to give them another one 3 days before they sign the loan agreement. And we're doing these whole loans. We're receiving the application and signing documents the next day. How are we supposed to do it 3 days before they sign? It was just ridiculous. And it was all this work. And then every time the examiners came, they're like, well, this wasn't really exact, because we just had to come up with generic numbers. because we were giving them disclosure. We didn't have time to do. Why make it take 3 days longer? So finally, they were like, "This is ridiculous. We're tired of dealing with examiners." So we changed to UCC filing.
Okay. Now, clearly that was a success because you guys are knocking the ball out of the park.
Yeah, it's about 3 years ago we changed, but our losses on these HVAC loans are almost zero. We went like 10 years. I think we lost one loan, and it was for a few $1,000s. So losses are because those people own their home. I mean, usually people who own their home, especially if you got a deed of trust, it's really low. So we were a little worried because, well, we're not going to have a deed of trust anymore. We only have a UCC. So the security is not quite as good, but our loss ratio was so low that we're like, no, let's do it anyway. And there's a few now and again, you got a garnishment. Good luck trying to go repossess the heat pump, with a UCC. Could, but it's going to be ugly and messy, especially if you're doing solar panels. We got one of those right now. But overall, the losses have been like ridiculously low. And we've got the corner on the market in our whole community here. So it's been a huge chunk of our portfolio.
Okay. So since you're not putting a lien on the property, what, I guess, are you guys using as a guide for pricing those loans?
Yeah, we just keep them the same as if there's a lien on the property. We just kept the price the same. So it's just like a home equity loan, basically. Yep. Okay. And the UCC kind of is a lien. It's a weird thing because it actually shows up on the title insurance. And you have to pay something to record it. And then you have to pay something to take it off. So there's a few little things to work out. But man, it's a lot easier than dealing with the deed of trust. Matter of fact, we worked with our core processor, CMC Flex, because we wanted to figure out a way to get them automatically approved and automatically signed. We paid them to develop the software. It's not great. It's not perfect, but it works good enough for now. So we can actually...
You paid your core to develop?
Yes, for us. So we just did this about 2 years ago. We did have this third party and we weren't happy with it. So we're like, it's a lot cheaper to pay our core to build something for us. So now you can actually go online. A person can, when they go to the heat pump store, or the guys are like, we're going to install a heat pump. And then they're like, okay, here's the application. And the application for it comes right into our system. And it actually will auto approve them. And it will send them the documents to sign in the middle of the night when we're closed.
No way.
So when we come in the next morning, like I say, it's not 100%. Doesn't always work. It's a little bit buggy, but working good enough. We're working on trying to fix it. So when we come in, we just come into our morning, open our system, like, oh yeah, okay, looks good. Yeah, we already got their signed documents. Open the account and fund the loan. And it's a UCC, so they just had to sign something saying we're going to record it with the UCC. They didn't have to sign a deed of trust or a notary or anything like that. So, oh man, they're fast and they're easy. So there you go.
That module that you had your core put together for you,
yeah.
Are you the only one using it, or have they since made that available to
Right now, we're the only one using it, but we're the only one that really does these HVAC loans anyway. So because they work well, you don't need to sign a car title or a deed of trust or anything. So the documents are easy, but they're trying to develop it to launch to other credit unions as we speak. They've been saying, we're going to expand ours to what they've developed for us and make it available for other credit unions. So we'll see.
So are they going to pay your residual on?
I know, right? Probably not. That's okay. We're happy. We got what we wanted.
All right. Hey, I got one last question for you on lending, and then we're going to bounce into a couple other areas. You were talking about the car lending. Clearly, you had mentioned your guy was going out talking to car lots and stuff like that.
Yep.
Are you buying the notes from the car lots, or are the borrowers actually borrowing from the credit union?
It depends. So if you're going to be successful as a small credit union, my experience has been you got to focus on lending, making it fast and easy. And since you're small, you got to find your little niches so you can fly under the radar. So we're always throwing stuff against the wall until something sticks and it's successful. So we try new loan products all the time. We're always looking for little niches because when you're small, you can develop a new loan product and launch it in like 10 days. So fast. If you're a giant credit union, you have to have giant volume and it's going to take you 6 months or a year to launch some kind of new loan product. So we're always trying stuff. So for a while, we had a deal with a fully guaranteed deal with a local car dealership where we would buy the contracts from him and he would fully guarantee them. So that worked great. And then if they went delinquent, he'd pay it off and take it back. But mostly we deal with car dealerships. And generally, of course, you can't fight the big credit unions for the big ones because they're paying reserves, and by the time they're done paying reserves on it, the margins are so thin you're not making money on them anyway. All these A credits, so we mostly focus on kind of the weird ones that don't really fit the box. So we have relationships with some of the small car dealerships. They get a little more losses on them because we're often doing B, C, D, E credit. So you got to be careful on that end. But we don't do a ton of cars. Most of our loans, honestly, are HVAC loans for the heat pumps. And we do maybe 25% of our portfolio is cars. And we do a lot of mortgages and manufactured home loans. So we kind of have a weird portfolio. Yep.
Now to kind of get into one of your passion projects that we were talking about, you founded the Endangered Small Credit Union Defense Initiative. What gap did you feel wasn't being addressed when you started that?
Yeah. So this was in January of 2025. So there was like this perfect storm where all these really annoying things happened, and it prompted me to form this organization. So I had my examiners, my NCUA examiners, and normally they're great, they got to do what they got to do. But they're like, we're going to come on like January 6th or something. And I was like, January 6th, which is like the busiest, month of the entire year, especially like the first 50 days. And I was like, this is absurd. And then they came and the stuff they were bothering me with. And I've been a very healthy credit union for about 15 years now. We've been one of the healthiest of all our peers, the most profitable, and perfect exams. Like we never have any serious problems at all. It's just always little piddly things they find. Anyway, and this exam again was one of these piddly ones where they're bothering you with things that have no impact on safety or soundness. They're not urgent at all. And like, for instance, I think I put this in the book too. They for 2 years now, the exam before that, they're like, doesn't look like you're filing very many suspicious activity reports, because we're a small credit union. We just don't have a lot of suspicious things. We notice it before it ever gets to the level that you'd have to deal with it. I'm like, yeah. So the backstory to that was in when I took over the credit union, they had been, right when I took it over, like almost 20 years ago, they had been told they needed to file more SARs by the examiner. So they filed a SAR, and then they got in trouble because the SAR wasn't warranted because it wasn't suspicious enough. So I'm like, we're not going to bother trying to write SARs on things that aren't suspicious just to satisfy the examiners. So anyway, so they're like, you haven't been filing very many SARs. You haven't filed one last year. I'm like, there's nothing suspicious enough. So they said, well, we think that you should document and justify every time you don't have to file a suspicious activity report. So basically, they want me to write down when things aren't suspicious. So this is insanity. So, and they did this 2 years in a row. Anyway, so they did it again. It was driving me crazy. And then they were like always coming down heavy on my supervisory committee, which is driving me crazy. And they came on down on things that were just absurd. And I was like, that's fine, we'll do it. But they're like threatening DORs on things that have new finding, no impact on safety or soundness, not urgent at all. And I'm like, just tell me to fix it. I can fix it in 5 minutes, Anyway, so that was driving me crazy too, because I was like, why are they wasting my time? And it turns out, of course, I found this out in the meantime, that NCUA does have a quota. They need to find a certain number. They're not going to leave until they find a certain number of findings. So if you don't have any big ones, they'll just keep digging and digging and digging until they find little annoying ones. So it's like, because I was like, what's the problem? I've been like super, super healthy, really good exams for going on almost 20 years. And yet every exam is like a complete nightmare headache anyway. So that was driving me crazy. At the same time, I had just gone to a conference with the CU's Unite group that Scott Pryor puts on. And he had this panel of big credit union CEOs. And the panel of big credit union CEOs they were talking about merging, because they'd recently merged small credit unions. So I was like, interesting. So I was asking questions like, what are commonalities, with these mergers, because we want to make sure our credit union is merger proof, and other small credit unions as well, because small credit unions matter. We're on the front line, with the heart and soul on the front line of these community lifelines. Anyway, one of the CEOs said, big credit union CEOs said, I estimate that in 10 years, there will be half as many credit unions. And all the other big CEOs on the panel, they nodded their heads. Yep, we think you're right. 10 years, there'll be half as many credit unions. And I was like, whoa, if there's half as many credit unions, that means the small credit unions are probably going to be extinct, because that's what happens. That's how that works. So that was on the top of my mind. And then we had just had this giant out-of-state credit union move into my small town. We're already surrounded by big credit unions. So this big out-of-state one that's very aggressive had moved into small town. And I'd heard about them moving into other small places over in Washington. They're from Idaho, and targeting the small credit union loans and the small credit unions that are already there. So I was like, this is a problem. This is weird. That never happened before. I've been in the industry for about almost 25 years. and it was always cooperation. Well, all of a sudden, there's like, we got these big out-of-state credit unions moving in and trying to take our business. So like, this is new. And then at the same time, I had reached out to my local league, and there's some good leagues, there's some bad leagues. They're all doing their best they can. But I reached out to my league, and I was like, man, these regulatory things are driving me crazy. Why am I having to do CECL? Why am I having to deal with NMLS? Why do I have to report to HMDA? I'm a tiny credit union. I do hardly any mortgages. And they're like, well, those are really hard things. Really, we just have to do things that matter for all credit unions. We can't just focus on things small credit unions want. And I was like, and then I was like, well, what have you done for small credit unions? Not basically almost nothing for decades, which is why these regulations keep falling on small ones. And I realized, well, that's partially my fault because I was never really there at the table. You know, they put on their advocacy things. And when you're a small credit, you're like, I'm busy. I'm wearing 10 different hats. I'm the CEO of this credit union. I don't have time to go to the advocacy things that my league or association is putting on. I just didn't have time. So why haven't they done anything for small credit unions? Well, it's partially my fault. You got to be a squeaky wheel. Small credit unions have to speak up if we want our associations to advocate for regulatory relief or whatever. So I realized that was partially my fault. So all those things kind of condensed into the perfect storm. And I was like, I'm going to do it myself. So I started this organization. It's just it's a nonprofit. It's a 501c4 or something, social welfare organization. And I started it last September. And I have two purposes: to advocate for regulatory relief for small credit unions. If it doesn't impact our safety and soundness for small credit union, and it doesn't serve really any purpose, then we shouldn't be required to do it. They're just holding us to the same standards of all the giant credit unions. Why are we being saddled with regulations that only apply to large, complex institutions? You know, they should be right-sized for us. And the other purpose was to encourage small credit unions to really give back to their communities. That's our whole purpose. We're supposed to give back to our members. So staying true to our not-for-profit cooperative status as well. So that's the organization I started a year ago. And it's been, some of the big associations have worked with me because I'm like, hey, I'll tell you what small credit unions need, and I'll do it myself. And I'll go to Washington, D.C., and I'll go to legislative. And my board of directors, they said, go ahead and do it. If you have time at your credit union job, we'll make it part of your credit union job. So they've allowed me to spend my time advocating for others, for small credit unions to help.
Yeah, as a matter of fact, before we started talking, you took me to your page. I saw the picture with you and Kyle on there. For any of our listeners, what's your website?
Oh, yes. It's the Endangered Small CU Defense.org. And it was kind of passionate after the Endangered Species Act because I'm like worried about small credit unions going extinct. So the Endangered Small CU Defense.org. And you're welcome to endorse us if you want. We don't take fees. I'm doing it for free. I just want to have, nobody really pays attention to small credit union needs unless we really get together and combine our voices. Then all of a sudden they pay attention. If you're one little small credit union and you go to your league, your association, they're kind of like, that's nice, you know. So that actually now I'm starting to get traction, and I've actually managed to get traction. One of the pages on my website is victories or progress we're making so far. So just the fact, because before that I was trying to get that meeting with the chairman of the NCUA, Kyle Halpin. I kept trying to contact him, and I never got any response. I couldn't get a meeting until I organized this group. And all of a sudden, guess what? I got a response. And all of a sudden, why don't you come over and we'll have a meeting? And that's what it takes. You have to represent a group. You can't just be flying solo. So that's the whole purpose, is just getting small credit union voices combined. And we've had good cooperation with like the DCUC, the Defense Credit Union Council, that's really listened to us. And they've been really working. Like, tell us what kind of things small credit unions need. The ACU, America's Credit Union, same thing. I know there's some leagues out there that are willing to partner with us too and help advance what small credit unions need. Because unfortunately, if we don't speak up, everything they're doing only helps the big credit unions while the small ones are going extinct. So that's why I wanted to stop. Yep.
Well, you've been there for almost 20 years. You've grown the credit union from about 15 million when you started to about 75 million. So you've been a driving force there. In your experience, what are the biggest operational mistakes hurting small credit unions financially?
Great question. And I actually apologize. I move around a lot when I talk, and I hope the microphone's not picking up my squeaky chair.
I haven't heard the squeak.
Okay, good. The biggest mistakes. So I actually did a bunch of research on this. So because I'm researching, like I mentioned, I want to write a book too for board members, small credit union board members. And so I've been doing some research on what causes small credit unions to die, to suffer, to struggle. Okay. I did some research with the NCUA. I reached out and had a meeting about a month ago with a bunch of the high ups at the NCUA to pick their brains on the commonalities they see when they see credit unions go under or get merged out. What contributed to that? I asked that panel at that CEOs Unite conference that merged small ones, what were commonalities you saw when small credit unions got? I researched reasons that are given, which are not really reliable, because just when a credit union is getting merged, they have to be strategic. It's a marketing channel, so they'll cite reasons why. And is that really why? We don't really know. That's just the reasons they're giving to try to encourage the merger to be approved in the vote. And I also reached out to Judy DeLuca. She's great. She's the CEO of New Orleans Firemen's Federal Credit Union. And she's about a $250 million credit union CEO. And she found out that there were 6 small credit unions in her neighborhood, right around there. They were all about to go under. They were like Camel 4 or something. But back in the day, associations and leagues used to go help those small credit unions. Doesn't really happen much anymore. And this is something I talked to the chairman of the NCUA about too. And he's like, yeah, they're relying on the NCUA to come help failing credit unions. That's not our job. We're just a regulator.
Exactly.
That's what our associations were supposed to be for, was for helping all the other little cooperatives that don't go under. Anyway, so Judy realized that. And she has a pretty good league down there. And actually, they worked with her and helped her a little bit, I understand. So they were great. I think Cornerstone, I think is what they're called. Or maybe it's Luminate. I don't remember. Anyway, so she went out on her own dime. She took her management team and went to these 6 small credit unions on her own and spent weeks in their shops and basically analyzed everything they were doing, gave them advice, helped them balance the books, taught them how to do proper loans. And she managed to save 3 of them. The other 3 were too far gone. They were already under. The cost and the lift were too great. But she saved 3 of those little credit unions by herself. So I asked her, what were the commonalities? She's great. She wrote me like a 10-page document that listed out all the commonalities for small credit unions. There it is, right there. I still got it behind me. I had it all marked up.
I want to get a copy. I want to get my hands on a copy of that.
Yeah. Yes, I'll forward it to you.
Okay.
So first of all, the credit union panel, they said one of the commonalities that they saw of the big CEOs was that small credit unions, when times were good, they signed up for some third-party vendor contract. They signed onto this contract, and it was really expensive. And then when times got tough, they couldn't get out of the contract, whether that was a new processing system or whatever it was. That was a commonality that they saw as well. The Judy noticed things like board governance. Either the board of directors is micromanaging or they're completely apathetic. You get these 2 extremes that contribute to it. Often it's a sudden loss of institutional knowledge. A CEO or a manager or a VP that just suddenly retires and leaves or passes away. And it's really difficult for a small credit union to survive from. Generally, what they saw is what happens is over a course of a few months, everything just starts to fall apart and unwind. And then by the time they get a new CEO, it's unwound for too far. And they've lost too much money and the strategy's fallen apart and accounting's fallen apart and they can't recover. Sometimes it's CECL. They weren't following CECL. And by the time they figured out, this was also combined with that other fact, the amount they have to contribute to their allowance is so high, it kills them. They just can't afford it anymore. Loan underwriting, obviously, loans are either too tight or too loose. That one's obvious, which can cause a problem. So those are some of the reasons she talked about. Often there's examination findings or DORs that haven't been resolved, and they'll go for a long period of time, exam after exam, without getting resolved. Let me forget. I want to talk about DIY and vendors a little bit more. Let's see. I could go all over. I actually gave a talk about this. I spoke at a Macuma conference over in Chesapeake Bay just last week, or week before last, on this exact topic. I don't have the PowerPoint slide in front of me. Personally, one of the things that I would say is, and then collaborations. For some reason, I think if a CEO is not collaborating with other CEOs, I think that contributes to their demise eventually. It's really important to be connected with the industry and connected with your peers. It keeps your passion up. One of the big problems, obviously, is a board of directors who doesn't have a passion about how credit unions are different and small and how we're supposed to get back to our members. After a while, who cares if you're just like a little bank, just merge with a big bank. One of my biggest things, well, okay, and then if you wrap it up to what do I think are the biggest reasons causing small credit unions to suffer? One is they're not focusing on lending. Lending's our bread and butter. You got to make your lending fast and easy and cheap. Uh, uh, Two, and competitive. And you got to find those little niches, find out where your little niches are and fly under the radar so you compete. I think often small credit union CEOs get too tied up with bells and whistles. You end up paying for all these expensive third parties, and it's just too expensive. You just can't do it. Everything possible, you got to do it yourself, DIY. Even though that's a lot of work, that's how you're going to save money. Otherwise, you're just going to go out of business because you're
That's
leaving.
so amazing you say that because I literally was just on a call earlier from a third party talking to me on how we can streamline, you know, HELOCs
Lasers,
and da 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 da.
lasers, sparkles, and everything, and think that's going to solve all your problems, and rarely does it. Maybe if you're huge, but when you're small, you just don't have the volume to
Yeah,
justify it.
I mean, this is like I remember years ago reading a book called Guerrilla Marketing, and basically it's bootstrap, being able to do things that we can do that's effective but not expensive.
Yep. And part of the challenge is the NCUA examiners or whoever the examiners are. Their goal is to make their exams fast and easy and have findings. They don't really care about your profitability or about giving back to members or anything, unless you're not profitable. So they'll come in, and if you've done everything yourself, it's a lot of work. Now they have to read over what you did and how you did it, why. They'd much rather you just hired some third party to comply with all these complicated regulations and to do your vendor due diligence management and then they can just, or your ALM, whatever it is, which I have to pay for that because they made it too
Yeah,
complicated.
same here.
Yep. Anyway, then they can just check the box. Be like, oh yeah, they hired a nice company to their BSA training. They hired a nice company to the manage their vendor due diligence. But so if you DIY, they don't like it because now it costs them more work. But you got to push back, unless it's really required and there's no way around it. You got to figure out to do it yourself and do it cheaper. So that's a big one. A great example of that is opening new accounts. So finally, last year, I've avoided online new account opening for
Okay.
years. Um,
Well, there definitely that's an area where you can have fraud seep in.
Absolutely. And I said, I don't want to deal with the fraud. It's complicated. Let's just avoid it as much as we can. So finally, last year, we're like, okay, we're gonna have to do it. It's with the future. Obviously, everybody wants to go on and open their account online. So I'm looking to do it. And my core has a pretty good module, but they're like, but you should integrate with like the FIS system or whatever, and it'll verifies the identity. And I look into it. It's like $2,000 a month. And I'm like, we're a small credit union. How many accounts are we going to really open? And how many of them are even legitimate accounts? So I'm like, I'm going to DIY this. So we used our free module that came with our system, with our core system. And then I decided, and then we figured out a way to just internally verify the identity by ourselves. We pull
Okay.
the check systems. Okay, that's $20. And then we go up and we do an address search on them, just in Google or whatever, to see if, because you can find out if their name even matches, if they're really from here. They're going to have to make a $5 deposit to their account using their debit card or credit card from somewhere else. So that's a way we can verify their identity because the money had to come into the account. We have a few little steps like that. We talk to them on the phone or something. We have to see a picture of their ID if they take a picture or whatever. So we do all these things together. We're like, good enough. So we did that for identity verification. So we're a small credit. What do we get? A dozen new account applications a month. One per month is legit. The rest are fraudulent. So
Wow.
if I would have paid $2,000 a month, I'd be paying $2,000 for a single new member account a month. What an absolute waste of money. Well, now, and anytime there's anything suspicious, we're like, sorry, you got to come in person. So about one a month. So there's an example. So all these other small credit unions like, we got to pay for the expensive ID verification, and they're paying $2,000 a month for like one member per month. So it's just not worth it. So a lot of these things, you really have to push back, figure out how to do it internally and save your money. So that's one of the big ones, DIY. Okay, I talked about DIY. I talked about lending. Pushing back on regulators is a big one because otherwise they'll swamp you with complicated best practices that don't really apply. You really got to push back and find that happy area where you're complying, but they're being flexible and you're doing it the simplest, easiest way. Oh, let's see. Where did I leave off here? The biggest things credit unions can be more profitable. Focus on lending, avoid DIY, push back. I think I got most of them. Are there any from my book that I forgot? I think those are some of the biggies.
I think those were some of the biggies. Now, after literally a 20-year successful career as a credit union leader. Um, you obviously have a passion specifically in the small credit union space. Um, Culture. How do you build culture in a small organization where the
Yeah.
employee feels they have impact?
Yeah. And that's a hard one. I don't know how you build culture. It's going to come from the CEO, I think.
It's
So
it's tough, especially if you have people that are kind of pushing back or kind of fighting
yes,
areas.
that's really tough. Maybe it takes shacking out all the bad stuff over time. Just I just have a positive personality and I'm a high energy personality and I'm a softie and I like people. So that kind of trickled out. And eventually over time, you hire employees and you can hire people that you like their personality. And that will impact the culture because members can tell when they come in your lobby if you got happy employees or
Oh,
unhappy
sure.
employees. Yeah.
Big time.
So, yeah. So I think that's a big factor. And that's a hard one to force.
Yeah,
I
especially
actually,
if they walk in, the first thing they see is a sour face on a.
oh yeah, yeah. So when I started, actually, we used to be an electricians union, credit union. So way back from when their credit was established, the electricians union, which we still kind of partner with best we can, they uh, they decided that the employees should be unionized as well. So when I started, the employees were unionized, the office workers unions, and that's difficult when you're CEO to manage because it's really restricted on what you can change, whether you can advance people or not. So it was really controlling. So it actually took me 5 years, and the office workers union I don't think was a very good value for the employees. They paid a lot of money. They didn't get a lot of benefit. Their dues were high. And it took them about 5 years and they realized that I was paying them more and doing better things for the employees. And I had their best interest in mind more than the union. And they realized Doug cares about us. He's watching out for us. The board cares about us. Why are we paying our money this union dues? And they actually outvoted the union,
Okay.
which was hot and messy for a while. The union tried to sue me, claiming that I was
Really?
trying to influence the employees. Well, and that's
Wow.
what they do. It was kind of a fear tactic, until the employees voted out and they dropped the lawsuits and they left. It was an intimidation tactic. So generally, yeah, that's probably what I say about culture. Yeah.
So you were talking about your new book. Have you I guess zeroed in on the title for your new book?
Yeah, I think I'm going to call it the board member Bible.
Okay.
Um, and it's going to be, I'm going to call it, let me look, I'm pull it up here. The board member Bible for small credit union officials. I think that's what I'm going to talk. So I
Okay.
got my chapters. I've got why you volunteer. This is written for board members. What am I supposed to do? Board member financials, just understanding the basics of the financials, the supervisory committee, how to decipher exam results, um, so staying trained, how to determine whether or not their CEO is performing. I want to put a chapter on firing the CEO and hiring the CEO, rewarding the CEO, compensation.
Yeah,
Um,
definitely spend some time on
yeah,
rewarding the CEO. How
yeah,
about that?
yeah. The chairman's role on the board, and also about mergers, when they're appropriate, when they're not, which is
Okay.
a big thing that happens all the time. So that's kind of what I'm shooting for. Yep.
Um, Couple, real quick questions and wrapping up here. What's the biggest misconception about CEOs?
Biggest misconception about CEOs. That we know what we're doing. um, I don't know. That's a good question. So I reached out. Okay, here you go. So with this endangered small credit union defense I put together, I've been surveying. I have a little group on LinkedIn. If anybody wants to go on and join the group, if you're a small credit union CEO, you can be part of the group and just see what we're doing. We post stuff on there. So every once in a while, I'm always advocating for what small credit unions need. So I've sent out only 2 or 3 surveys over the last year to small credit union
Okay.
CEOs. So I sent out one trying to figure out why small credit union CEOs even take the job, because it's a lot of work and it's exhausting, and the pay is it's not like
Yeah,
bankers.
it's well because you end up wearing about a half a dozen hats at
Yes.
least.
Yep. Yep. So it turns out one of the reasons we like this job and why we do it is we like to wear lots of hats. Kind of fun to wear a lot. It's kind of fun to wear lots of hats. You're doing something different every day. It's always interesting. It's not boring.
Yeah, it's never
Um,
the same day twice, that's for
Never the
sure.
same day. Yep. Yep. So that's kind of I don't know if we all have ADD personalities or what it is, but that's kind of fun. The other reason that is by far the top three. That one, um, we really care about, we love giving back. Oh, let me pull it up. We love giving back to our communities, and giving back to members who need
We
it.
all
Making
love our communities.
Yep. And we really love the cooperative movement. There you
Oh,
go.
I agree.
Yep.
I was just talking with the CEO yesterday. I mean, the collaborative people helping people, it's something that we have that almost not any other industry even has.
Yep.
That here we are, two CEOs being able to share ideas and help each other and grow our whole industry.
Yes.
It's just
Yeah.
it's just one that's not like that in almost any other
No, no,
industry out there.
no. So we're a passionate, unique group. So yeah, it's crazy and we don't make a lot of money, but we love wearing hats and we love the credit union movement. We love giving back for people that need it. So there you go.
Okay, one last question.
Yeah.
One thing every new CEO should stop doing immediately.
Yeah. I would say if they're a new CEO, well, I don't know if I can give something they could stop doing immediately. Really, there's multiple different things. It kind of what I went over before. Stop hiring expensive third parties. There you go. Yep. Every chance possible. Figure out a way to do it yourself and save money. There's something to stop doing, because man, you'll put yourself right out of business with expense. And stop taking all the advice from your examiners. Only do what you have to do by the regulation, because they'll put you right out of business too with all their great ideas that'll just swamp you with paperwork and policies. And I had my last exam. They're like, here's a best practice for this new policy. It's like a 10-page policy. And I was like, what? And I managed to whittle it down to 38 words. And it was supposed to have, the policy required you to have like a date when you were going to do something. I can't remember the trigger. And I put it in there. And my date for when it'll do it is when I think it's necessary.
All righty.
I just saved myself 10 pages of complicated policy and triggers.
This was an outstanding conversation. I appreciate not only your honesty, but your willingness to advocate for the future of small credit unions and the communities that we serve. Thanks again for joining us on Credit Unions Forum podcast, and to everyone listening. And if today's conversation brought you value, make sure you share, like this episode with other credit union leaders, leave a review, and continue supporting the movement that puts people before profits.
My pleasure to be here. And I've got lots of articles on the CU Daily if you want to go there too. And it's unorthodox, but hopefully some of it was useful. Thank you, Greg.
Excellent. Thank you.